We're going to discuss what we are seeing in the indices at the end of today. It's an important juncture, and I'm going to start with Bank Nifty because I believe that has some more clarity in terms of what is developing. So I'll start with what the Bank Nifty is telling us, and I'm pulling a trend line of the last two lows, which is essentially connected, and the highs, which is connected. So what you're seeing here is a broadening formation, and each of the declines inside this broadening formation, especially from this, the highest point, is a series of 5-wave declines, which means this is 1, 2, 3, 4, and 5. Okay, and similarly, if I can mark this either as 1 or A. So if I say this is 1, this is 2, this is 3, this is 4, and we're actually looking at what might be a series of 5-wave declines. Now, should I mark it as 1, 2, 3, 4, 5? The answer is you can, if you consider it as a leading diagonal. So that is the first possibility, that this entire 5-wave decline, because it's 5, 3, 5, 3, 5, which is what you usually see in a trend and a direction, but it's not supposed to overlap between 1 and 4, except that if it is a leading diagonal. Now that a leading diagonal is always a contracting pattern, but in rare cases you can get a leading expanding triangle. I've tried to consider this type of pattern before, not with success, but the thing is, it hasn't always followed that way. So, and this is just a first stage look, because it's a very, very rare structure that would occur. The meaning of a leading diagonal would be that you would actually do a retracement of this entire move, okay, which means a 50-60%, almost back to the top end of the line at least, because this is expanding in nature. If it was contracting, usually I would say only 38% retracement is what you get normally, but this would be too big, my sense is, though it is almost 61% if you reach the top end, and then you falter from there and then start a larger. So this 5-wave decline would be wave A or 1, and then you would start 2 or B. So this is one alternate. The second alternate, which would now might sound more logical and in terms of the wave structure, ignore these touch points, because what we've really completed is a 5-wave down here. So let me also mark this. This is also 5. And so far what I was considering on the Bank Nifty was that this could be minor wave. So this could be a major A, this could be B instead of 1, this could be C. Now if that is the case, this is again X, and then what is this 5-wave decline? So the best case scenario is it is A, and then you get followed by a B and a C. Now this is a more logical flow, which is easier for people to comprehend and understand, and if I go by that, I just remove these broader lines, then we are looking at ABC X ABC, series of 5-wave declines instead of 1, 2, 3, 4, 5. Then what you would really expect is wave B up. Now wave B can be small, big, it can turn into a triangle, but it can do 50 to 60% as well. So now even in this case, if you do a 50% retracement, you would end up at 29,845, 61% would end up at 30,254. So you have these two potential retracement levels, staring at you. But of course, you need a confirmation that this 5 is complete, which means that the 5th will not extend. Now, of course, usually after the 3rd is extended, you don't expect the 5th to extend. You expect the 5th to be just equal to wave 1. And if I do that projection, then that's what we almost did today. So we've almost achieved that number. Unless we attempt to, fall more, we've probably completed this pattern. So unless 5th is extended and this is some kind of a wild crash, we've completed a 5-wave decline that calls for either a wave B bounce or a larger 1, 2, 3, 4, 5 A, which is again A. So leading diagonal is also A. Either this entire is A and a larger retracement, or only a retracement of this last leg. One of the two things is most likely, and it also means that even if I mark it as ABC X ABC, I still have a wave C down, which means in either alternate, we are looking at a further decline in the market. Now if this fall had ended in 3 waves, which is what the Nifty may look like, I'll go to the Nifty next, but this gives you a perspective that Bank Nifty at least is telling us that we're going to be getting a major wave lower from after the next bounce. So that's the risk preview. In fact, 50% retracement is just at this gap zone, and I had mentioned earlier yesterday that the gap zone is basically a recognition point of this fall, and sometimes you might actually not fill it. So now that you've gone this far, a 50% retracement in wave B only comes back to the gap zone, and then you start wave C down. This is also possible. You might just not fill this gap. You might not go to 61% and simply return from the gap area itself. So you need to be aware of and prepare for that as well. So that, in fact, that might, like I said, this may sound more logical rather than 1, 2, 3, 4, 5. The only thing is we like 5s. I like a larger 5 because then you can start mapping a longer term bear market in a A and a B and a C. If you end up getting a smaller sub waves, then it becomes a complex corrective right from the beginning. So that's the only big takeaway or difference. Maybe at a later stage, the way this develops, we might end up marking it as 1 2 1 2 3 4 3 4 5, which is if this bounce is even smaller. Say for example, you don't even go above this minor wave 4 and then you start heading down. What would you do then? Then you have an alternate to, instead of doing ABC, you could do 1 2 1 2, then 3 4 and a 3 4 and 5 to complete a larger 5-wave decline, if that's what we're really looking at. So before we go on to the Nifty, I just want to highlight that we are starting the registration to the next session of our mentorship program, which starts in the last week of April. For those who don't know, this is a 3-month program which goes in depth into analyzing markets from various angles and putting it all together, which is the combination of classical technical analysis, trade setups with Elliott waves, looking at how you do that on an investment and trading time horizon, and then filtering out the most high probability trading setups. So this is the entire thing which we're doing in a combination of both webinars and residential program. And the reason we're doing it that way is we found a lot of people who are outstation who couldn't attend our Mumbai session over 3 months because it was Sunday to Sunday. So what we did is do a 6-day comprehensive residential and then follow it up with weekly webinar. So that will be, this is a different format that will be starting from the last week of April, which also has 3 holidays. So basically anybody who's from outside or who's working needs to at least take 3 days off to make that possible. And if that interests you, you really want to understand the application of Elliott waves to every part of financial markets and how to study momentum and those trade setups and put it together, then just get in touch with the number you see on your screen, which is Chavan at 6361666629. So that's all from me. See you there. Okay, so that's given you 3 different ways of marking this, each of which is telling that there's more downside after any pullback, whatever the pullback is. So that's the, I think, clearer takeaway coming from the Bank Nifty. Now, when you put that perspective onto the Nifty, one of the things which happened today, which supports the potential for a bounce back, is you got an intermarket divergence, which means the Bank Nifty did its 5th wave, breaking this previous swing low that we made on the 2nd of March. The Nifty did not. Now, by not breaking it, the Nifty, Bank Nifty actually has positive hourly divergences, whereas the Nifty is a little complex, looks a little different. You don't know whether the 5th even formed, even if it's truncated, because this last leg, at least on hourly, looks like a 3-wave decline. So are we still doing a 4th wave? That is the first thing that you'll think about. If that's the case, then we're probably looking at today's dip as B. So this was A, which is 3 waves. Then this is B, which is also 3 waves down. And then you're doing C, which could be a 3 or a 5, because this is sort of a flat, maybe a flag. If you draw a parallel channel, you only go back to around 11,400 to 11,440, the range we were anyway looking at since yesterday. And that means the 4th wave is still going on. So this would support the case of 4th wave in Bank Nifty also, the last alternate. And whereas in this case also, you wouldn't really go above this despite what is happening in other markets, and you start wave 5 down. So this is the first possibility that we could be dealing with. The second one is that I actually end up considering this entire topping zone, instead of marking this as a Z orthodox top, as a triangle, which means this is the this is 5th of A, basically A of 5. And this is a B, this is a C, this is a D, because we did have doubts about this fall, because in terms of a channel, it's only looking 3 waves. You would have to really get into internal, smaller, lower time frame subdivisions to fit a 5. And then you have this bounce back, which is again counter trend. So is this entire setup a triangle? Now, if that's the case, then this is not 1. Actually, this entire fall is 1, and if what you're doing is a wave 2 bounce. Now, if you're doing that, it would fit with a larger B structure with Bank Nifty, where you can get a 50% or 60% retracement. The only thing is, in these retracements, we end up filling the gap, and that's something that I've been unsure of. I thought the gap zones that we've left behind, either in the US indices like the Nasdaq, which I'm discussing in a separate video on YouTube, but just for the sake, let me show that chart. So this is a chart I'm actually posting. I've already put it on the site, so you'll get it in your mail. And what I'm showing is that this is wave 1 and we are in wave 2. This does A, B, and C. We're already seeing world markets pop up a bit in the futures. So we'll see where the actual trade goes that way. And if it does, a 66% retracement of wave 1 is just near the gap zone. So clearly, if this is wave 2 does 66% for the Nasdaq, it will not fill this gap. And so the gap actually will remain intact. So that's what you usually expect with a recognition gap, which actually recognizes that something is wrong and you break down from it. So you can call it a breakaway gap. I'm just saying that it's the one that actually recognized that we have a problem. So similarly, you have one in the Dow right up there, and you have one in the S&P. All the indices have a gap, but much at the top end of the range. In case of the Indian index, you have it closer to the bottom end. But I've also thought, based on some prior examples of such big gaps in 2015 and so on, and 2012, that 2011, that those gaps marked actually the halfway point of that sell-off. So I did believe that if this is the halfway point, you can go to around 10,800 eventually, but that really requires that you don't fill the gap. So case number one is you're doing a minor fourth, you just go back to 11,400, don't fill the gap, it's still a fourth wave and we head lower. Case number two, this is a triangle, we do wave one, we are doing a larger wave two, we pull back to 50 or 60%, and then go down, in which case the gap gets filled and then we eventually head lower. So these are the two alternates I see for Nifty, and the reason I say head lower is I think more certainty coming from the Bank Nifty, that is the case going to be. So we are going to expect this move up, but going to look at the potential failure, which is becoming a greater case, especially looking at what currencies are doing. So I think currencies are the primary source where you take a macro view, and clearly the currency market, whether you look at the emerging markets index or whether you look at the ADR index, which I published earlier in the day. So this index clearly shows that you've done 1, 2, 3 and 4, which is in line with what most Asian markets are doing. It broke the lower end of the channel. It's pulling back in a fourth, which can usually go back to the minor wave 4 high. So it has room to go up till here. And once it does that, we would probably expect the fifth down to occur. And the same is what you're actually seeing even in the EM currency index. And the same is what we are now seeing in the USD INR. Now this is a chart from my saved chart. So you see a lot of markings and indicators on it, but if I just squeeze out a bit, see the RSI has actually reached a high of around 75, which is not the highest we've seen readings of 80 and above in this move and many other major swings. What has been big this time is not the RSI, but the volume and open interest, which have really spiked to the highest level since 2013. So that's, I think, the new feature. In these 3 days, huge buying has occurred. Now you're getting some kind of a pullback intraday today, so the daily close today is slightly low. I believe that would be a minor fourth. Now since the INR has broken out, it's 1, 2, 1, 2, 3, 4, which means you have another 3, 4 and 5 on the upside left. So it's completely incomplete, and as long as the USD INR is heading higher, I wouldn't see equities really pull back or head higher till that point of time. So we still have risk on the table. All we are looking for is a pullback in equities, would maybe accompanied by a pullback in the INR, and the hourly chart shows that you have space for around a 30-40 paisa kind of a pullback here, possibly tomorrow in minor wave 4, and then you should probably go up again. But we've broken past this previous high, which was at 72.40, so I would not expect us to go back below 72.40. That would be the worst case if there's a really sharp reaction, but typically I think somewhere around 70 to 80, 70 should be a good support for the move up to really resume. So I hope that gives you a fair outlook in terms of what to expect from the indices over the next couple of days based on various posts that I've been making, and that should leave you with a better understanding of what they all mean. Thank you.